All right. Eric Douglas, Chris Vaughn here with another episode of the Retirement Planning Happy Hour. And we have got a really good bottle of bourbon that I've never tried.
You're going to enjoy this.
I've been told anyway that that it is very good. I know it's a little bit of a rarity here, so I'll let you talk about the bourbon here real quick, and then we'll get into kind of the topic of the day here.
All right, so today we're drinking Charter Oak, and this is Charter Oak. This is the French oak barrel aged. So basically, what they're doing is they're doing what's called secondary aging. They are either putting French oak staves into the barrels, or they're taking the juice, as it's called, out of the barrel and putting it into another barrel that's made out of French oak instead of American oak, which is what's required for bourbon. And it gives it some different flavors. It's actually a fairly popular thing to do now. This is actually a Buffalo Trace product, if you know that. That's your Blantons and your E.H. Taylors and Stags and all that kind of stuff is made out there. It is a 12-year-old bourbon, so if you know anything about bourbon, that tends to be the sweet spot for complexity. I have had this many times. It's fantastic. It has a really cool bottle. Some of the people here in the office were admiring the bottle beforehand because it's got there's a wood disc, coin, whatever you want to call it, on the front that's laser engraved. So it's just unique. So that's what we're drinking today. I will tell you that this is kind of difficult to find. It's classed as a rare. Retail on it, I believe, is $80. Secondary is $150 to $250 for this bottle. I know that I paid $90 for it about a year ago. So I've had a little bit above retail.
Still have that thing a year later. Huh?
I still have it a year later. Well, it's working it down a little bit. But it's perfect for things like this when you just get to share and enjoy. And quite frankly, that's what bourbon is for. So That's what we're drinking today.
This is a good pour. I like this one.
Yeah, it's wonderful flavor to this.
Just the right amount of aftertaste. No burn down the throat. A little bit of an aftertaste.
No, it's 92 proof, if I remember correctly.
Yeah, that tastes good.
Yeah, 92 proof. So it's not super hot, but it's got lots and lots of flavor to it. There's a lot going on in there. I don't care what your palate is like. You're going to find something in that you like.
Yeah, no, that's a good one. I'm a fan of this one, so we will.
This one may make a return. Is that what you're saying?
It certainly could. Yeah, I'm definitely a fan of this one. So.
All right. So what are we going to talk about today?
Well, so I figured today we chat about real estate a little bit.
All right.
Because we have a lot of clients that come into our office that talk about real estate. They have rental homes or Airbnbs. Mm-hmm. We see that quite a bit. I've got some really good friends, and I've got my sister, and I'm kind of relatively clued in with a lot of realtors around town. Okay. I know you are as well. Yep. They tend to be great referral sources, and so we tend to know a lot of realtors, and realtors will talk to you about the value of real estate and how much or how great of an investment it is. Mm-hmm. And not to say that we're not here to downplay real estate by any means, but I think we wanted to have a little bit of a broad-based discussion about real estate investing specifically.
Right. Okay.
And what spurred this topic was I was on Twitter, which quite frankly where I guess it's X now, whatever.
Yeah.
I'm still not calling it that.
It's still hard to change that.
Yeah. But so anyway, I was on X and I came across a thread that it was, and I don't even follow this guy. I don't know how it came up. I guess somebody retweeted it or responded to it or something. But I follow a ton of investment stuff,
right,
on X, and that's primarily what I use it for. And so I was looking. I came across this thread, and it was a guy in Austin, Texas, who had sold a rental property of his. He had bought a rental property to Airbnb it. And it was basically going through his experience, and he was showing line by line what all his expenses were. So I figured we would start with this.
All right.
And then from here, kind of riff on real estate a little bit, pros and cons, and maybe talk about any stories that we've come across. And really talk about the dangers, if you will, or things to look out for if you are investing in real estate.
All right. Excellent.
So this guy, his name is Noah Kagan, Kagan. So once again, I do not know this guy. I don't know anything about him. I just came across his X thread. So I bought a property in 2017 to Airbnb it. Purchase price was $315,000. Put a down payment of $63,000 with a goal of passive income, baby. Today, I sold it for $377,750. But let's compare that to the return if he had put that money into the S&P 500. So for the first 6 years, I made about a 4% cash-on-cash return. Not bad until it wasn't. The last 2 years, zero profit. I broke even after repairs, maintenance, and all the joy of being a landlord. And we can talk about we can talk about what some of those joys might be, right? So 8 years later, cash flow returns of about $17,000, appreciation of about $62,750, mortgage paid down $40,173 for a net profit total of about $11,390. Yes, really.
Wait, say that number again. 11,000 what?
$11,390 over 8 years.
Wow. Okay.
And in quotations, it says, yes, really. So now let's say I just put that same $63,000 into the S&P 500 in 2017 and went on with my life. No leaky toilets, no surprise HOA roof repairs, no property managers messaging you about at 1 a.m. about parties going on at your property. The result, about $108,037 in profit. So let's recap. Rental return on investment, 18% total over 8 years. S&P 500 return on investment, ROI, 171% total over 8 years. That's a 10x difference. The hidden truth, owning property can build wealth, but it is not liquid. Had to cover costs for a year while it was listed on the market. Saturation, the market got flooded, and this guy, once again, is in Austin, Texas specifically.
Yeah,
so obviously we're here in Louisville, so it's not the same type of a real estate market, but this is by no means unique to Austin, right, Texas either. But the market got flooded in Austin with Airbnbs, which reduced my returns greatly. Hassles, even with property managers, which you have to pay for. You will always have issues. In IRR, internal rate of return, compare the returns to other investment opportunities. So you don't want to strictly focus on your return on real estate, but you have to compare it to what you could have gotten elsewhere, right? So if I could go back, I'd index and chill. Let the S&P 500 do its thing while I focus on business and life. So as Ramit, or he tagged somebody else, I don't know who this guy is, but he says, as someone says, real estate can be great, just don't let the hype make you think it's passive or guaranteed to outperform. You really have to understand the full cost and all the hassles that come with it.
Right.
So I think,
wow, what a story.
So it's a great story, and I think that's a fantastic representation because, you turn on HGTV, you turn on House Hunters, and you watch these shows about how, these guys come in and they flip a house in 30 minutes and they make just ungodly amounts of money on a flip, right? Or they'll, some will turn into a rental or whatever the case may be. And real estate has really gotten very glamorized because of a lot of those shows. And so it's important to understand those risks that he just outlined are very, very real. And we see those a lot when we talk to clients. And I've got another client I can think of right now that has a rental property that she's probably looking to sell. But the guy at the very beginning of his story, he said the key word, he said passive income. And so many times we hear clients come in thinking that, they've been, it always goes back to what people see on the internet or what people hear from their friends, right? And passive income becomes a very, very popular topic.
And it sounds awesome.
And it sounds great, right? Passive income, money that just kind of comes in, out of the dark, and I can sleep at night and I know that I have money coming in through the door. And it just does not work like that. Especially with real estate investments. So that was kind of the spark, if you will, that led me to think about this topic, and maybe we needed to explore this in a little bit more detail.
All right. So the first thing that I did, and you had read that story to me before we started recording. He makes the comment that if he had just put the money in an S&P index, okay, fine. All right, let me play devil's advocate. Most people don't have the stomach to put their money into only an S&P 500 index and let it ride, right? So let's assume,
because there is a lot of volatility.
There is volatility. And if you think about it, so this started in 2018, 2017? Okay. So 2017, 8 years back, right? Good, I did my math right. So 8 years back. So in that time frame, if you think about it, you've got 2020 when the market plummeted in March. Now, we had that big V-shaped return that so many people thought that's what's going to happen every time. That's not the way it works.
Even in 18, we had a pretty bad December.
That's right. 2018 was a bad year. You're right. Then you had 2022, that was a negative year. So that's part of it. So I went the opposite direction. I said, okay, what happens if we put the money in a money market, which you don't have that kind of volatility. You don't have the risk of loss that you do with the more volatile investments like the S&P, right? So just for argument's sake, I don't remember what the rates were in 2017. I know what they are now. I know what they've been the last couple of years because I can still remember that. I took that $63,000 investment. I put it into a money market at 3%. Compounding monthly because that's the way most money market accounts do, right? So it's not an annual compound. What was his total profit margin? 11,200 something?
He made a total of $11,390.
With all the headaches and all the backed up toilets and the 1 a.m. party calls, if you'd taken that same $63,000 and put it into a money market, getting 3%, $17,064.
Yeah. With zero volatility.
With no volatility,
zero
no
risk.
work, no nothing. Oh, wait a minute. You got to pay capital gains on that. But you got to pay capital gains on the investment property as well.
Yeah.
So
and this doesn't go into, he probably had some write-offs and, on the expenses. And that's why a lot of people get into real estate because they use it as a tax play.
Yep.
And they think that they're, fooling the IRS and,
you're not fooling the IRS.
You're pulling one over on everybody. And
Right.
it's just the ultimate tax play. But, at the end of the day, taxes aren't necessarily a bad thing if you've made money. You're only paying taxes if you've made money. And in this case, at the end of the day, he really didn't make much. So all the effort that he had over an 8-year period with this one specific investment, and obviously not all real estate is going to turn out like this.
No.
I wouldn't call this a horror story by any means because he did make money on it. And there are plenty of horror stories out there where people
they lost,
money. But I think this is probably more indicative of most real estate investments that I hear of, far more so than the stuff you're going to see on HGTV. Where it's not nearly as grandiose. You probably make a little bit of money, but you're not making the grandiose returns that you probably envisioned when you first went into that world.
So let me break apart a couple of things that you'd said in there. We talked about passive income. All right, how attractive is passive income? Who doesn't want to make money and not work? I mean, that sounds fantastic. And it's not a pipe dream. It does exist, but it's not as passive as you might think. Right? And this is a great example of it. This was not passive at all. He had a lot of stuff going on there.
Well, it sounds like he didn't for the first few years.
Right. Until
he did. And that anybody that owns a home understands when stuff starts to break.
It
starts to break.
Yeah, it's we've got an administrative assistant here in our office who's going through that right now.
Yep.
Things tend to come in waves. I tell people all the time, especially when you're dealing with younger people who are thinking about buying their first house, and they say, well, we'll buy new because then we won't have any problems. Man, this is not a new car where you get a warranty, right?
Yeah.
If you own a home, something is broken or is about to be.
Yeah.
I don't care if it's a new home or a 200-year-old home.
Well, even if you buy a new home, it hasn't settled yet. So
right,
once it starts
exactly.
Settling,
and then all of a sudden there's a crack going through your brick, right? And we both own our own homes, so we know. There's always something to do, and therein lies my point. I have worked with a lot of clients who own a piece of real estate for passive income. They're a landlord. I've also worked with quite a few clients that own multiples. Mm-hmm. The ones who own multiples are the ones who actually get the benefit out of it because, you own, let's just say 5. If you own 5 pieces of rental property, you got a problem with one of them pretty much all the time, but the other 4 are still paying out without you having to put time into it.
The scale.
Yeah, it really is. And that's been my experience. I grew up in a real estate home. My dad was a real estate broker. So, he did the rental thing and he did the flipping thing. We'll talk about that here in a minute. I saw all this stuff and I heard about it at the dinner table every night. I've heard the nightmare stories and I've heard the fantastic ones. And there's a lot of both. If you are going to own real estate for the purpose of passive income, not flipping, that's a different animal. My advice would be you have to own multiple properties or it is not going to be worth your time. And we just illustrated one guy, he made money on the deal, but he had a lot of some of the typical problems. Investing your money in a money market, we're talking bank CD rates here. This is not fancy stuff. he would have had considerably more profit over that same 8-year window. So that would be my advice: is if you're going to go all in and buy 5, 6, 7 properties, and that's your job is to take care of those, it can work, and it can work quite well. But if you think you're going to buy one piece of real estate and that's just going to supply your lifestyle, you got another thing coming there.
Yeah, so I think that is probably the key. The ones that I've seen that have done really, really well, and I do have some friends that have done very well with real estate investing.
Oh, sure.
So by all means, it can work. But the ones that do it well are the ones where it's their job. They treat it like a job. They form an LLC. Right. They're hiring property managers and they're hiring contractors and they're doing it the right way. They're not trying to go, buy a house on the side while they still have a full-time job, and they're, going over there on the weekends and trying to, fix everything themselves and trying to do it on the cheap. That's not what the most successful real estate investors do. That's just not the way that it's done.
That's right. Well, you hear, about people who have, mega high wealth and they own real estate, which is almost always true.
Yeah.
I've never spoken with somebody who has an ultra high wealth, ultra high net worth family that doesn't own a lot of real estate, but they own enough that they can justify paying somebody else to do the work. It's passive to them because there's enough income coming from 20, 30, 40 properties that they can hire somebody else to do the work and they can go relax and enjoy it. You just said it, spending your Saturdays and Sundays fixing the house. Man, I cherish my weekends. I got too many other things I want to do, right?
Well, you just mentioned high net worth clients, and you said the word generational, right? Mm-hmm. So generational is key because that denotes the amount of time that it takes to really make a ton of money on real estate. It's not a get-rich-quick thing.
No.
A lot of people think you're going to, flip a house and make a good amount of money, and some people maybe do. But the people, everyone talks about how the wealthy always own property. Well, yeah, but typically it's probably property that their grandparents or great-grandparents bought. Or, they bought land, and then, we had urban sprawl, right, or suburban sprawl, and the city moved out, and then quite frankly, a lot of folks like that just got lucky. Because their grandparents bought a plot of land out in the county.
That was worthless at the time.
However many years ago, and then the city just got bigger, and then now all of a sudden someone wants to put a development on it. That's not exactly something you can plan for, and you definitely can't plan for it within your lifetime.
Right.
If
you knew that was going to happen, everybody else would have already bought it.
Yeah.
Right.
It's also worth noting, too, the ones that, a lot of this became sexy when real estate prices were skyrocketing. That's not happening right now. Not to say that real estate's depreciating, but there has been a definite slowdown in the appreciation of home prices as far as what houses are actually being sold for. Mm-hmm. So there's really a lack of supply right now because a number of different things, and we don't need to go too terribly into the reasons why this is happening, but with mortgage interest rates, we're not at 3% mortgage rates anymore. So you're talking about 6.5%, 7% interest rates to finance a mortgage. Exactly, yeah. And so
I just finished refinancing mine.
Yeah,
wow.
Which goes into kind of the costs of, you have to calculate the cost of actually being able to afford real estate, right? But and that makes it prohibitively more expensive to do so right now. But it's just far more expensive to go out and buy property right now. And because it's so expensive to go buy property, there's fewer people that are leaving their homes. Myself, I am the perfect case
great
study.
Example. Yeah.
My mortgage is less than 3%. I refinanced when the rates got extremely low. I like my house, don't misunderstand, but I'm stuck in my house for the foreseeable future. It is so prohibitively more expensive for me to move out of my house in the near future, because even if I were to go make a sideways move and sell my house and buy something for the exact same amount of money that I sold my house for, I have to take my sub 3% interest rate and basically do a new mortgage and refinance that at 6.5%, 7% interest rates with, by the way, pretty good credit.
Yeah.
Okay. I'm not a sub credit borrower. I'm not I'm not a subprime borrower here. So, it just becomes that much more expensive for me to move out of my house. Yep. Yes, I would make money on my house if I go to sell it. The problem is, all the other houses I would buy have gone up in value too.
So while we're on that, I've got a good story that just popped into my mind. When we talk about selling real estate, there's a couple of things you have to think about. There's the home that is not your primary residence, and there is the home that is your primary residence. Okay, so let's clear the air here a little bit. When you buy a house at X number of dollars, that's your basis, and when you sell that house, you sell it theoretically, you sell it for a higher amount because real estate appreciates. The difference between the basis that you bought it for and the amount you sell it for is a capital gain. It is a capital gain. However, if the home falls under primary residence law, which means you have to have lived in that house for 2 out of the last 5 years. That's important to this story, so we'll come back to it. Then you get an exemption of, I don't remember the number. I want to say it's $750,000. Please don't quote me on that. For a household, that means that profit of $750,000 is exempted from capital gains tax, which is why the vast majority of us, like you and I, we can sell our houses, we can buy another house, we can make money on the deal and not have to pay taxes, right? So you're kind of locked into your situation because of that fabulous interest rate you've got. When those rates were really, really low, my wife and I made the decision not to refinance. We were already pretty low. We were 3.5. But we decided not to because we knew we wanted to move. Yeah. Right? We just had to find the right place and the right timing. So we didn't go back and do that. And when we sold our house, we made a chunk of money on it because it had appreciated. We took good care of it. We did some improvements, right? Just natural appreciation. We didn't have to pay taxes on that because our profit was less than whatever the number is, 750,000 something. But what happens if you don't do things correctly? So great story. I think you're familiar with it. An accountant friend of ours had a client that, and I may screw this story up, so be patient with me. But first of all, they fired their financial advisor because they didn't feel like they were getting value from their financial advisor. Well, and their advisor was a true planner / wealth manager, the way that we like to do things.
And this was so this actually is a story that leads into the value of an advisor, even as it doesn't necessarily pertain to traditional investments per se, but
and I was getting to that point.
Holistic planning.
Most people think of a financial advisor, they're advising around investments.
Yep.
Some of them, that's all they do. That's true. But a good wealth manager, a good financial planner, the way that we like to do things, there's so much more to it. So anyway, the accountant told me that, hey, this advisor is somebody that would fit in really good with you guys. Very similar mindset, right? So anyway, they fired their advisor because they didn't feel like it was worth it, right? And this is a very, very high income family, $850,000 a year salary. So they decide that they're going to sell their house and purchase a new one. Now, this is primary residence, but they had been in this house for, I remember him telling me the date. It was 2 weeks shy of 2 years. 2 weeks, right? Because they had lived there for less than 2 full years of the last 5, that exemption didn't exist, right? And the profit on that house, first of all, it was a very nice house, very desirable area. I was told it was not here in Louisville. I don't know where. But anyway, it checked all the boxes for this is a nice place to live. And it appreciated quite a bit in the 23 and a half months that they lived there. The capital gains tax that they had to pay, which would have been in their particular bracket, that would have been 20%, 23 and a half, whatever it works out to. The capital gains tax that they paid on the sale of their own home was slightly over $250,000. Mm-hmm. They fired their financial advisor, and it cost them $250,000. I know how much he was paid. I will not say that number here on the air, but they could have paid him for quite a few years before they got to the $250,000. But the point there is, number one, good counsel on this kind of stuff. If you've got a good wealth manager, they are not going to tell you don't ever buy real estate. They're going to tell you be smart in the way you do it, and they're going to walk you through it. And you need to understand the tax law because you can get burned on it. So the other one I would go into, I'm going to totally change gears, and you may want to jump in here, Eric, is 1031 exchanges. Mm-hmm. Right? You want to take that ball, or you want me to go with it?
Well, you can go ahead and start.
All right, so
yeah, I'll take it from
I
there.
hear 1031 exchange a lot. And this is what happens to the real estate investor when they own one or two pieces of property as rentals, as opposed to owning, a portfolio of real estate. So a 1031 exchange means, based on that story I just told you, okay, so this is not your primary residence. When you sell it, you got to pay capital gains on that growth, right? And you want it to grow. It's supposed to. If you do a 1031 exchange, it means that you sell the old house and then you buy a new piece of real estate within, I believe it's 1 year. Does that sound right on time limit? There's a process you have to go through.
Oh, no, it's not 1 year. It's within.
Is it less than that?
Oh, yeah.
Okay, so anyway, it's if you make that sale and you purchase more real estate and you do it by the rules, you need to talk to a good title attorney to work this out. It's called a 1031 exchange, and you don't have to pay that capital gains on there. But therein lies the problem. And you said it before we started recording today. Once people get into real estate, they have a tendency to get trapped into it. They can't get out because of the tax burden or the liquidity.
Well, they focus so specifically on the taxes, and this is what you hear a lot of real estate investors talk about. Like they use it as a tax play, almost like they're pulling one over,
right.
The IRS, and that's not the case.
It does not work.
Not doing that, right? But so they use it as a tax play, and they can claim all this depreciation and all these expenses, and they can get all these write-offs. And okay, well, but that doesn't negate the fact that if it's not a good investment, it's not a good investment, or if it's not a great investment, that's all the tax credits in the world aren't going to cover up a bad investment, right? Not to mention all the hassle that comes along with it. So as it relates to 1031s, let's say you get into you flip a house or you make money on a sale, okay, right? And it goes well. Let's say it was a good investment. Here's the issue with real estate is you typically tend to get trapped into real estate because you think, oh, I just made some money on my house. Now I'm going to have to pay all these taxes on the gains. Great problem to have, and so many people look at taxes as a horribly bad thing. It's really just all about the way you frame it, because you're not paying taxes if you didn't make money, right? And sometimes the best tax strategy is to just pay the damn tax.
I had that conversation with somebody this morning, right?
But anyway, that's a whole other podcast topic, right? But so you do a 1031 exchange and you basically sell your old property and you move immediately into a new property, like for like, essentially. It's kind of like rolling a 401k, rolling money from a 401k into an IRA.
Sure.
It's going into basically the same type of a product, but there's no tax liability to exchange it from one to the other. That's what a 1031 is. And when it says like for like, it basically means from one piece of real estate to another piece of real estate. Mm-hmm. That's actually a fairly broad definition, because you could go from like a residential to an industrial, like a manufacturing facility, or like an apartment complex. Or
right.
It's not necessarily just single family
house
residence.
For house, right?
Yeah. Exactly. So, but you do the 1031 exchange, and that way you just take all your proceeds and you roll it into the next one, and you don't have to pay taxes. The tax liability doesn't leave you, okay? You still have a tax liability. You're just deferring it because you're taking that tax liability and then taking it and applying it to the next property that you own. And then it's a domino effect, right? And so maybe you flip your second house, and then now you even have a bigger tax liability, and you do another 1031 exchange, and you keep going from one house to another, right? Then you get stuck. And then this is one of the issues with real estate in general, and the gentleman whose X thread, Twitter thread that we talked about.
X thread just doesn't work for me.
Doesn't roll off.
Yeah, no, it doesn't.
But that was one of the things he said. It's illiquid, so you can't change course if you are trying to move into something else, or real estate is no longer what you want to be doing. However, you have this big tax liability. It becomes a burden to still hold on to this tax liability, and you almost feel trapped in real estate investment, and it's hard to diversify at that point. Because you've kind of let the tax tail wag the dog, so to speak. And you don't ever want to make all of your decisions solely on what the tax liability is going to do or going to be. And we see that a lot with real estate investors, because they're just scared to move out of real estate because they have all this tax liability that they have to pay.
I think it goes back to, we tell people all the time, what is the purpose of money? The purpose of money is to buy the things that bring you joy, that make you enjoy your time here on this earth more, right? If your money is trapped in an investment, if the goal of the money is simply to get bigger, You're never going to be satisfied with that. And that's the problem that you're talking about is the illiquidity because of, first of all, there's a process to sell real estate. And second of all, because you are trapped in that tax, consideration that you don't get to actually enjoy the money that you're making.
Yeah, so it kind of becomes a vicious.
It's a vicious cycle,
but it
right?
becomes a vicious cycle, right? So I actually have a client who, by all definitions, was a successful real estate investor, and he had multiple properties. He also had another 2 businesses, and he quite frankly got sick of the real estate stuff, sold it all. Yeah. So he sold it all. He got to a point where he just couldn't handle. His other businesses were doing better from a percentage standpoint. He said, the margins are far better on what I'm doing elsewhere in my other 2 businesses. Right. I'm going to focus my efforts over here because I have far more bang for the buck than what I'm getting on my real estate stuff. So he ate the tax burden. I mean, he went ahead and sold his properties.
Bit the bullet and got it done.
It was a lifestyle decision. He said, I'm sick of dealing with these rental properties. He had some apartment buildings and some single family residences, and I forgot the total of everything that he sold, but it was well into 7 figures. So he sold all his properties. He said, I'm done with it. I'm just sick of it. And he took the proceeds and invested in his other businesses for a greater return. So it does happen, but it kind of took him getting to that tipping point where he just could not handle managing those investments any longer.
I get it.
And it also took him realizing that there were far better opportunities in some of the other things that he was doing. Not everybody's like that, and he's going to be obviously probably a little bit of an exception to the rule, probably for most real estate investors. But once again, this was a guy who did well.
Yeah.
He by all means, he was a successful real estate investor, and to him, it just wasn't worth the time and the effort. I've had another client, her mom or her dad, I don't remember, one of her parents passed away, and she inherited a house, and we see this a lot.
Mm-hmm.
Somebody will inherit a house, and instead of selling it, they have the great idea to earn what? Passive income, right? So they're going to go earn passive income, and they're just going to rent out the house, and now they're going to own 2 properties. They'll live in their primary residence, and they're going to, rent out the other one. Well, she's come to realize that she has some issues coming up. So she's been renting the property out, and she's had good renters. She actually, I think it's 3 or 4 college kids, and they're actually, pretty good.
That is impressive. They got college kids that are good renters.
Yeah, but they're pretty good. It's not out by U of L. It's out in another part of town. Okay. But it's a decent little neighborhood, and it's she's not had any problems, and so she doesn't want to kick them out by any means. But she also realizes that she's not charging them enough, and she probably needs to raise their rent. But she's stuck in this thinking where she's afraid to raise the rent because she probably knows that they're going to have to move.
They might not be able to afford it, right?
But she's also understanding that she's looking at her roof, and she's looking at her HVAC, and she's also looking at the kitchen, and she's like, these are all old. Every single one of those 3 things is going to need updating probably within the next 2 to 3 years. Yeah. The HVAC system's over 20 years old. The roof is pretty old itself. I don't remember how old the roof was, but she was saying the roof is going to need to get repaired here pretty soon, and the kitchen is horribly outdated. And if they were to ever leave, in order for her to attract another good tenant and justify increasing the rent, she's probably going to have to update the kitchen, at least to some degree.
So between those 3 things, let's be real honest, you're at least $50,000, even in a fairly small house, to replace all of that.
Exactly. And let's say she were to, because she owns it free and clear, but let's say she were to take out a loan against the house in order to do all of these things, the amount of money that it's going to take her to make these fixes, to make these enhancements, is not going to be she's not going to get the return if she were to turn around and sell it, right?
Right.
If she were to try to sell the property as is today, it's 6 of one, half dozen of the other. It's not really going to make her any money to make these, fixing the roof doesn't really add value to your home.
No, it maintains value.
Exactly. Updating the HVAC system is not going to add dollars to your sale price. And so that's what she's facing right now. So she's kind of in this predicament where she kind of wants to sell it, but then she kind of feels like she can't. She's just kind of stuck. And she's making money. She has tenants in there, but it's not like it's a lot of money. And I've run the numbers for her relative to, okay, if you were to sell this house, this is what the house is worth. This is what you could get if we were to invest it in some type of a portfolio. I don't remember the number. I think I was showing her kind of a 5-6% rate of return. It's actually greater than what she's earning on the on the rent currently, not including the cost of any repairs, right? So that's going to dig into her profit quite a bit. So it's just, there's so many different things that you have to account for when you're looking to move into real estate, and so many people just get into this idea that it's easy and it's passive income and all I have to do is collect the checks. It's not
as passive as you might think, and it's not easy.
And quite frankly, most of the time, it's not nearly as good of an investment as what you see on TV, or even what you hear a lot of. I have a lot of realtor friends, but a lot of realtors are going to talk about the benefits of home ownership and the benefits of real estate and the benefits of real estate investing. Well, I mean,
that's the world that they live in. I mean,
it's the world that they live in. And I'm not discounting that, but once again, it's kind of like anything, right? It's kind of like any business. You're going to have those that do really, really well, and everybody else is everybody else is trying to model themselves after what the top 5% are doing, and what the top 5% are doing is not normal.
Fair.
And that's why I always laugh when people, let's equate that to our world, right? DIY investors. What do we see? A lot of DIY investors taking unnecessary risk in their portfolio because they're watching TV and they're trying to model what these hedge fund investors are doing. and what they're seeing on TV, and they're like, oh, I'll do it myself. How hard can it be? I'm just gonna buy the Mag 7 and just follow the index, and hey, it's easy, right? No.
There's a central theme here. People are getting their information off TV and X or Twitter or whatever. Elon, if you're watching, because I know we're so popular that Elon's got to be watching us. X is not working for us. Get something different. Or TikTok or whatever it is. That's not the place that you need to be getting your information, because you're seeing the real success stories as opposed to what 99% of people are actually getting. They're making money, but they're not making money in an efficient manner, and they could have done so much better in something different.
And that's always the case with any investment. You have to analyze not only the return on your investment in that specific, whatever that specific investment is, but you also have to analyze what it could have been, what the opportunity cost is if you had invested in something else or done something different with your money. Because there's always a risk. Every investment has a risk. Sitting on cash and you're safe.
Huge risk.
At home. There's a huge amount of risk affiliated with that. It's not market risk, right? It's not going to, lose value if the market collapses, but there's inflation risk.
It's inflation risk. That's right.
So there's what's called opportunity risk. There's an opportunity cost with every investment that you make. Meaning, if I invest in this, I might get a pretty good return, but I could have gotten a better return.
What if you had done this?
If I had done something else. Or I could have gotten a worse return, right? There's always an opportunity cost with everything that you do. There's always a risk with everything that you do. It's just a matter of what risk is acceptable to you.
Speaking of the word opportunity, I'm going to pause this for a second. I want to talk about the opportunity to drink a really good whiskey. So, first of all, we joked about the fact that we have to record this first thing in the morning.
Mine's gone. So,
as is mine, and that's my point. I think that needs to change, because we are not recording in the morning. We're recording in the afternoon, and that is so delightful. I'm going to have to get another pour of that.
Another little small pour there.
There you go. Excellent. Thank you very much. If you have not had this Charter Oak, and I am unaware if there is any kind of Charter Oak that is not this French oak version. If there is, I would love to try it. I don't know, but this stuff is fantastic. The next time I see it, I will grab another bottle if I can get it at this kind of price. And then I will enjoy this one that much more, because
it's going down smooth.
That's good stuff.
There's no aftertaste here.
No, this is if you're a bourbon connoisseur, or I would say a spirits connoisseur, there's a front, a middle, and a back to the taste, and you know what I'm talking about. Sometimes you'll get a front and a middle that are really good, but the back part of it kind of leaves something to be desired, or maybe there's nothing there, or maybe there's nothing on the front, but it's all on the back. Man, this one is good all the way across the board. It does have some distinctly different flavors that are popping up, but this is one that you could drink every time you have a drink. You could have this one and be thoroughly pleased.
A little hard to find, though. You probably don't want to waste it for everything.
Yeah. That's what I'm saying. If I ever find another bottle, I have a friend of mine that is quite the collector, and he will not open a bottle until he has a second one. That way, in his mind, he gets to enjoy it more. Well, I would enjoy this bottle a whole lot more knowing that there's another one available if I ever finish it off. So, yeah, cheers to the people who put this one together.
Well, that's a pretty good stopping point here while we pour our second drink and enjoy this. Anything to wrap up the conversation around real estate?
Real estate can be a very, very successful form of investment. My challenge to people would be, if you're going to be investing in real estate, you need to understand that you got to put a lot of money on the table in order to make it work. You have to buy multiple properties to make it work. I know of a guy personally that owned 30-something rentals, and he was making a killing, but he didn't own the rentals. He was mortgaged on almost all of them. And in 2008, actually in 2006, when the mortgage problems started coming up that led into 2008, he lost pretty much everything. So if you're going to be successful with being a landlord, you need to own multiple properties, and you need to not have debt on the bulk of it, right? If you got a little bit, that can be okay, but you need to not have debt on the bulk of it. If you want to get into other forms of real estate investing, like flipping can be a very, very profitable thing, but it's not passive. You got to do the bulk of the work yourself to make it cost effective. You and I both have friends that do a lot of flipping, but they also are very handy. They've got people who will do certain jobs for them on the cheap because they provide them with a lot of income, but they don't just constantly search for that next house to flip. They just keep their eyes open. Well, and when something comes up, then they're ready to go.
Well, I'll also add this too. I mean, we're talking about, especially if you're like the average consumer on the market. If there's a good flip opportunity on the market, you're never going to know about it.
That's right.
You will never see it because everybody that's got a real estate license that has access to these things, somebody knows about it before you do. You will never even know about this property. Most of the time, the properties that you see listed publicly available for sale, they've already been passed over by all the professional real estate investors.
Understand, flipping does not work unless you can buy it low, clean it up in a fairly short period of time, put $5,000-$10,000 into it, and sell it for a $30,000, $40,000, $50,000 profit. Right? To your point, if it's a really good one, there's too many people out there with real estate licenses that's the only thing they use it for, is to search for that next flipping property. So just, to your point, Eric, if it's out on the market and you go, ooh, that's a good one, it's an open house, I'm going to go look, that's not a flipping property. So get that out of your head.
I'll add one more thing too here. So Warren Buffett has a famous quote, when he buys a company, what does he say the ideal holding time for that company is whenever he buys a company? His investment strategy.
I'm going to be real honest. You caught me off guard. I don't remember. I believe it's hold forever, is it not?
That's his philosophy. Yeah. So Warren Buffett, one of the greatest investors of all time, just announced he's actually stepping down as CEO recently. So cheers to him.
Yeah.
But not that he needs it.
Wow.
But he always says the ideal holding time for any company that he buys is forever. He takes that. He's saying this into his 90s, right? On the second half of his 90s now. But that's the way that he approaches investing. You have to approach real estate, especially real estate. You have to approach it the same way. All these high net worth individuals and all these clients that have generational wealth, a lot of that's because of the things that their relatives did decades ago. This is not something where in your lifetime, in most cases, you're going to make a huge amount of money. Can it be something that you can begin to create a legacy for your kids and your grandkids? 100%. It's a fantastic way to do it. Yep. But it's not something that is a short-term play, is all that I'm saying. And you have to take that view with most of your investments, but also especially real estate. It becomes far more fruitful the longer you buy it and you leave it alone.
I'm going to add one more thing before we wrap this up. If you are thinking about doing some real estate investing, or you're already doing it, it can be a great play, but too many of the people that I have talked to about real estate investing who own 1, 5, 10 properties, whatever, tax is a major issue here. It is a huge part of this play, and you can burn yourself. And I asked them, who's your accountant? Oh, TurboTax, tax cut. What they're doing themselves and they're just using the software that's on the market. No cut on the software, guys. Please go out and hire a good CPA who understands real estate taxes. It's going to pay for itself multiple times over, and it's going to take so much pressure off of you.
Well, going back to that generational thinking about buying and selling real estate and having a generational view of it, when's the best tax break that you get for owning real estate? When does that occur?
When people die.
Exactly.
Right.
So you will,
sounds morbid, but it's true, right?
So you won't be around to realize the best ultimate tax break of owning real estate, which is when you die, the cost basis steps up. And so once again, going back to the generational factor, the generational thinking about owning real estate, that's the approach that you have to have in mind, understanding that in your lifetime, you probably won't realize all of the tax benefits of owning real estate. Your kids might, grandkids might, and that's a fantastic benefit for them.
That's why they call it generational wealth.
That's why they call it generational wealth. Yeah. So anyway, it's pretty good way to pretty good spot to wrap up on. Great bourbon, great pick. Charter Oak, was it French Oak?
Charter Oak, French Oak.
Yep.
Once again, I don't know if this is the only Charter Oak out there. It's the only one I've ever heard of.
No.
That doesn't mean that there's not others.
I'll have it again. Yeah. So that's a pretty good place to wrap up. Thanks for joining us. Please like, subscribe. Check us out next week. Thanks.